Well, for more on this, Nathan Bell from Peters McGregor joins us now live from Sydney. Nathan, hello to you. Thank you for being with us. I did want to start with some of those leads that we did have coming through from Wall Street in the healthcare space. Really very interesting. It had been quite the bright spot in last week's trading action, but we did see shares just fading slightly into Friday. Investors not seeming so sure anymore about the Republican plan to repeal and replace Obamacare.
Yeah, look, I don't have any real insights into what's going to happen from here, or at least insights that anyone else doesn't have already. But I think the most important thing for investors is that a lot of this stuff that Donald Trump has proposed has already been baked into share prices. So if I look at the US market overall, it's very expensive. Personally, I'd be steering well clear of ETFs and any sort of passive strategy that relies on a broad index of US companies, because I just think they're very overvalued on average. And I think these healthcare stocks again, have already baked in tax rate reductions and also potentially revenue increases that may not even happen. So I think it's an area where you need to be very careful.
Because with that in mind, I mean, we've seen hospital stocks in the US moving higher in last week's trade, but many analysts turning around saying that in the longer term, of course, this is going to be bad for some of those corporations and for some of those stocks.
Yeah, the US healthcare system is extraordinarily complicated. It's not like Australia, where we just have a few. I think the most healthcare stocks that we tend to look at are CSL and ResMed, but in America you've got all sorts of listed companies across a wide sector. Anyone that provides generics, for example, at the moment is potentially going to be under pricing pressure. You know, we just don't know what's going to come out of this, and with valuations being so high, it's just not an area where we're finding any value.
Just speaking more broadly then, when it does come to the US sector, we've had even some of our Wall Street commentators, while acknowledging that Wall Street is likely just to continue grinding higher and some of this Trump talk will become just background noise, there has been a suggestion that perhaps investors should be starting to take some sort of insurance betting, as it were. What are you guiding in terms of providing that hedge, as it were?
Yeah, I mean, the first thing for us is we're international investors, and we actually try to provide Australians with diversification overseas. So I think for an Australian point of view, if you can just have some overseas exposure, I think that's a good thing anyway, given, excuse me, most people are very full of Australian property and banks in their portfolios. And I think the other thing too is you need to realise that the American market is fully valued, because it's offering, I think what everybody wants is this feeling of safety, you know, big brand names, a bit of growth through the technology companies and growing dividends. But you know, if I look at some of those brand companies, they're trading on multiples of 25 to 35 times earnings, and their revenue hasn't even grown over the last 5 years. So that's not an area where you want to invest. I think you want to find a good active manager that can actually navigate and find undervalued securities for you.
Well, just to pin you down to some of the names that you're talking to in terms of that risk that you're seeing at the moment, yeah, we think of companies like McDonald's and Pepsi and Kellogg's as being some of the world's both largest and also safest stocks. But to that theme that you were just speaking to, you're actually seeing these as some of the riskiest.
Yeah, I think so. These businesses used to be wonderful companies. I pick on McDonald's quite a lot, and the main reason is earnings actually haven't gone anywhere since 2009, and yet the price to earnings multiple has doubled from 13 to 26. I just find that amazing. But even the companies like Kellogg's or Procter & Gamble, people see these as very safe businesses, and they might have very stable revenues, but they're just not growing, and yet their multiples are enormous. And we're also starting to see companies like Amazon reduce, you know, all this marketing spend and advertising that these companies have used to build up their brands over, you know, decades. All that value is starting to disappear, because now people just want convenience and cheapness, and that's not what they offer, and that's what Amazon does. So I think the intrinsic value of those businesses are probably overstated at the moment, and their competitive positions are weakening, not getting stronger.
So to that end then, in terms of, and as you mentioned already, you know, you look to offer clients diversification. I mean, what are some of the Aussie stocks or the ways in which that you are looking to diversify? What are some of the stocks that you do look to at the moment?
Yeah, I mean, the UK is an area where the Australian dollar is reasonably strong compared to the British pound, compared to where it's been in the past. And again, I think you need to be selective, because the UK market is actually quite similar to Australia's, and it's got lots of resources company and lots of banks. But a bank we actually like, it's an up-and-comer, it's called Metro Bank. It's only a £3 billion business. It's aiming to take 4% deposit market share over the next 10 years, which will potentially make the company worth 4 to 5 times more than what it is today if it manages to pull that off. It's actually founded by a guy called Vernon Hill, who was very successful with a company called Commerce Bank in America, and in over 30 years that company produced a shareholder return of 23% per year, which is incredible. And interestingly, this company offers dog bowls, and you can bring your kids in and throw your coins in the counter, all these sort of things for free. So it's very kid and pet friendly, and 80% of the rental costs for each branch is actually covered by safety deposit boxes. So this is a very unusual bank, but I think this is what you need to look for in the market, is something a bit different, and we've got really motivated owner-managers.
Absolutely. Nathan Bell, great to get your insights this morning. Thank you so much.
Thanks, Natalie.